Okay, welcome to our Finance Friday weekly course. I want to say hi to everyone that's on Facebook, Zoom. If you're watching the replay here on YouTube or any of our other channels that we're on, I want to welcome you to our weekly Finance Friday course. We've been doing these for years now. I'm Jerry, the owner and founder of Wealth Dynamics. And this week's topic I'm very excited about. We're going to be talking about what I call the sacred account tier 3. Okay. And this is a thing that is probably one of the more interesting topics that I get questions asked about. It seems to be a very inquisitive subject. When I bring up the home equity line of credit, the tier 3 account, oftentimes people either don't understand it, so they want to learn more, or they've never heard of it, so they want to learn more about it. Because all we've ever been preached to about is the 30-year mortgage, right? Get the mortgage, pay off your house, the normal story. And so this is something that's very different from what's traditionally being used. And it's something that I think is actually the right way to own a home. Okay. So my story on this, I want to share with you guys. I rent. Okay. And so part of what I'm going to share with you is the strategy we are going to cover tonight has to be done in the right sequence. If you do it in the wrong sequence, you're not going to be able to do it at all. Right. And I'm a person that didn't know that. And so years ago, I did things in the wrong sequence. Because of that, this is a strategy I can't do right now. And I'll talk to you guys about why in a second. Some of you that are watching might already know the answer to that. But this is the home equity line of credit, sacred account tier 3. Okay. Now, this is a course that we're going to go into that will have some vocabulary and it's going to have some math, right? Which is all finances are, is vocabulary and math. So if you're watching this and anything I say at any point doesn't make sense, I want you to stop and ask questions, right? So if there's words that I use that aren't something that you're used to hearing and you're like, what does that mean? Punch it in the comments. I'll definitely answer it. I want to make sure we clear things up and simplify them. I'll do my best to naturally do that, but I need you to have your own personal study integrity and on, okay, I didn't get that. What does that mean? And asking. Okay. Same thing with the math. If I go over any math that doesn't make sense, ask questions and we can break it down and further simplify it. Second thing is, what is your purpose for being here tonight? Okay. Why are you watching this course? What are you going to do with the information? If you don't have that, this particularly is going to be a very hard course to pay attention to, because this would only be for someone that's going to use it, right? We're going to talk about a very specific strategy, a very specific niche. If you're not someone that's going to use this strategy or this niche, the course really doesn't apply to you and there's no reason to watch. So I want you to think about, what is my purpose for being here? How am I going to use the information tonight? Okay. And then third thing is, make sure that you're coming from a standpoint of production, not consumption. It's very easy to sit back on a course like this because we're used to so many webinars, right? Webinar after webinar, guru after guru, influencer after influencer. And all we do is consume and consume and consume. Oftentimes we're never challenged to use the content. Okay. So this is not a $300 Gucci belt that you buy and wear around and you're cool because you have one. I don't think you're cool just because you're here, right? Like, to me, that doesn't matter. I think you're cool if you use the information. So think about, again, production. How can I be a producer during this course? How can I contribute? How can I ask questions? We will jump on live at the end of this. So if you're on Zoom, we'll mic up and talk and we'll actually communicate. If you're on Facebook, you can drop your questions in the comments and we'll answer those live as well. Okay. So without further ado, this is called the sacred account tier 3. Okay. Now, the reason why I call it the sacred account tier 3 is because we have the sacred account, which is life insurance. That's tier 1. Right now, there's this thing called a 3-tier capital system. It's how banks actually capitalize. It means it's how they build up their reserves and their assets. Tier 1, banks actually do put about 20% of their tier 1 capital in life insurance. Okay. So that's something they really do use. Tier 2, if you look at, banks and central banks, like for example, the Federal Reserve Bank, about 80% of their reserves are in gold. We use gold as our tier 2. Tier 3 are typically lines of credit that are, usually going to be collateralized against an asset that is considered a revaluation asset, meaning it can go up and down in value. Revaluation, it can move in price, right? So we use the home equity line of credit for that. It's perfect. And this is something that we can actually use alongside the tier 1 and tier 2 strategy. And it helps us get to financial freedom much sooner, right? So that's why we call it sacred account tier 3. We use the word sacred because it has a purpose. We don't do anything other than that purpose, right? So what is this? This is actually a first position home equity line of credit. 3 different terms we have to know there. First position, home equity, and line of credit. So I want to break these down first, okay? So the first one I'm going to go for is actually the middle one, because I think most of us already know what this is, home equity, right? We've all, lived in a house, owned a house, rented a house, and we understand equity equals the ownership in the property, right? So if I have equity in my home, when I sell that house, the equity is what I get after the debt's paid off, right? So there's the equity, that's the value. There's the debt, the liability. The liability gets paid off, and then whatever the surplus is my equity. So the equity is that value, the excess value in my actual home, okay? Now, this term first position, this is a lending term, right? So let's say that I borrow money and I go buy a house with that money. On the title of that house, the bank is in first position, meaning if I don't pay my bills, the bank gets the property. Okay. Now there can be second positions and there can be third positions, and it can go all the way down the line, but the first position means they have the first right to the title. Okay. So once I pay the title off, then I become first position because the bank's no longer there. Right. So first position, your mortgage, if you have a mortgage, is first position because it's the first lien or loan against the title of that property. Now, the third term is the line of credit. A line of credit is like a loan. Okay. Now I'm going to break this down simply. There is what I call a one-way loan, and there is what I call a two-way loan, right? Now, two-way is always better than one-way. I relate this to communication. Money is a communication. We send money from one terminal to another, from one point to another. That's a communication, right? Whenever you communicate, you want two ways, meaning when I say something to you, you hear it and understand it, and then you say something back, right? That's called a conversation. That's a good thing, right? Communication is never fun when it's one way, where I say something to you, no response, or you say something to me, no response. Nobody enjoys that, right? So with a line of credit is a two-way type of loan, meaning I can put income into it, I can pay into it, which is normal with debt. We normally would pay our debt, we'd put a payment of some sort, but I can also pull money back out of it. Very different than a one-way loan, which is like a mortgage. I pay into the mortgage. I can't pull the money back out of the mortgage. Once I give it to them, it's theirs forever until I refinance or sell, right? So a one-way loan, I want you to think about a mortgage or a car payment or a student loan where I pay them, and what I give them, I can never have that back, right? Versus a two-way loan, I can put the money in and I can pull it back out freely, and there's that flow in and out. So a line of credit is a two-way loan, not a one-way loan, right? So a first position home equity line of credit means that we have a loan, a line of credit against the home equity, our home equity, the ownership, the value of our house or our property. And that loan is first position on the title, meaning we don't have a mortgage. We're getting rid of the mortgage. We're replacing it with this home equity line of credit. That's where you hear the term Heloc, home equity line of credit, HELOC, right? So that's what this is. That's what those terms mean, okay? Now, again, any questions, I want you to drop those in the comments. Now, when I first started getting into finances, I was taught you do a 15-year mortgage. You put 20% down to avoid the extra insurance costs on financing a property. You do a 15-year mortgage and you try and pay the thing off as fast as possible. Okay. Now, there's some benefit to that, right? It's nice to not have a house payment. But if you look at, and I'm going to start with this, if you look at the benefit of that, let's say that you're financing a $400,000 house. Okay. So $400,000 house, that's going to be probably about $2,000 a month for your mortgage payment. Means you're paying about $24,000 a year. Over 30 years, you would have paid about 720 grand. Okay. If you just kept it for 30 years, right? And so the idea was, well, you don't keep it for 30 years. You pay it off early. You do a 15-year loan. You aggressively pay money towards it. You pay it off and you never have a house payment again. And you own your house free and clear, right? Two problems with that. The best case scenario, if I do that, the best case scenario, if I do that, is I save $720,000, right? That's all I'll ever get. That's all I ever make. That's the only opportunity or return that I have, is that $720,000 that I no longer have to pay. Because again, $400,000 house, that's about $2,000 a month, which is about $24,000 a year. If I pay that $24,000 a year for 30 years, that's going to be my 720, right? So that's the benefit, right? The downside is, what if I could make more than that? Right? What if I could make more than $720,000 and I'm shooting myself in the foot by paying the house off early, and now I have what I refer to as dead equity, right? Meaning all I ever own is a house. It doesn't grow or produce passive income for me. It might go up in value, but I never realize that unless I sell it or take out another loan, which if I just paid it all off early, I probably wasn't planning on taking out another loan, or I would have never paid it off early in the first place, right? That's the first thing. The second thing is the idea that I own my house is a myth. Okay. Real estate, the origin of that word actually comes from royal estate, right? We're talking serfs and lords here, right? Back in the day when we had serfs and lords and we had, peasants, and the lords owned all the land and the serfs would, farm the land and rent the land from the lords. Royal estate was the tax that the peasants and the serfs would pay to the royalty. They would pay to the serfs, or sorry, they would pay to the royalty and the property owners, right? So this idea of royal estate means that we have lords that own all the property. They're the royalty, and that's their estate, and the serfs live on it and use it, and they pay taxes to do that. Okay. Doesn't sound familiar until you really simplify it. You pay the house off. What do you still got to pay? Property tax, right? Why would you have to pay property tax if it's your house? If it's your land? Why would that be there? Because it's royal estate. It's not yours. It's still the government's, which is why you have to pay an eternal lease to live there, right? Think about that. So I'm not saying don't own a home. I think that's polarized and an unintelligent statement to make. Everyone's different. I rent, you might own. It might be a better idea for you to own. But I'm saying paying off the house early has opportunity costs. Best case scenario, I save all my house payments and I save everything I would have paid on a 30-year mortgage. Boom, $250,000, right? Potentially, right? But worst case, what if I could have made more than that? And then worst case, what if I'm fooled by this idea that I own the house now when I really don't own it? I still have to pay my taxes. Okay, so I want to talk about that first. Now, what would be the purpose of the home equity line of credit strategy? And I want to cover this and really be specific about it, because there's a lot of different ideas behind this. There's very specific and distinct purposes. The first purpose is to reduce my actual housing costs. That's the number one thing that I'm trying to do with the home equity line of credit. I'm trying to reduce my housing costs. I'm not trying to pay the house off early, right? I'm not trying to leverage or any of that. That might happen down the road. It might be secondary, but I'm telling you the primary purpose of having this is to reduce your housing costs. The secondary purpose of having this home equity line of credit is to increase your savings rate, right? What I mean by that is if I've reduced my housing costs, my fixed expenses have gone down, which means I have more money to save, right? So if I save that money, my savings rate can now go up by the exact amount of dollars I save by reducing the housing costs. It's like an axis, right? This one goes down, this one goes up, right? Cost goes down, savings goes up. So that's the second thing. The third reason I would do the HELOC is to increase my passive income. Now, I'll talk about how to do this, but I want to share with you, this has nothing to do with renting out your house. You don't have to be a landlord. You don't have to run an Airbnb. Like I said, passive. Landlord is not passive. Airbnb is not passive. We're going to talk about how do you turn your mortgage into a passive income stream. Something that's actually passive. You don't trade your time for. You don't fix toilets. You don't clean up and tidy up the room and put little, peppermint chocolates on the bed pillow before your tenants come in. None of that. We're talking passive. And then finally, the fourth reason I would do this is to reduce my taxes. That's it. There's 4 reasons someone would do a HELOC. Okay. None of these reasons is pay the house off early. Okay. None of these reasons is the broad general blanket statement of OPM or other people's money. It's like, we're talking reduce the housing costs, increase the savings rate, increase the passive income, reduce the taxes, right? So the example I want to start with tonight is an example of a household that's earning $8,000 per month in net income after taxes. $8,000 a month in take-home pay, in other words. We're going to look at a $400,000 mortgage, like a traditional mortgage first, right? So $400,000 mortgage. On that $400,000 mortgage, this is going to be about a $2,000 a month payment. If you're looking at a 4 to 5% interest rate, I know they're lower than that, but we're not talking about if you locked it in today. We're saying on average, when we look back over history, 4 to 5% interest rate is reasonable to look at, right? So we're going to say that that's about a $2,000 a month payment between principal and interest. Now, the other thing that we have to look at when we own a house is the things that are not principal and interest, but are a guaranteed cost of owning a home. Okay. Those costs are HOA dues, taxes, insurance, utilities. What does that say? Maintenance. I can't read my own handwriting. Repairs, closing costs. Most people roll those into their loan, and then commissions when you buy and sell property. You might pay real estate commissions. You might pay loan origination commissions, things of that nature. Over a 5 to 7 year period, which is the average amount of time that a person in the United States owns their home for before they sell it, over a 5 to 7 year period, if we total all of that up and divide it out per month, that comes out to about $1,400 per month. right? So 2,000 a month is principal and interest. The rest is dues, taxes, insurance, utilities, maintenance, repair, closing costs, and commissions, which is about $1,400 a month, which means that we are spending about $3,400 per month on housing in order to live in this $400,000 house, right? That's the mortgage. The house might be worth $450,000, okay? But that's the mortgage option. Now, if we take the same scenario, same house, same income, same everything, and we run it through a home equity line of credit instead, I want to show you what happens. Our housing payment initially from the get-go drops to $1,300 a month. Okay, so we went from a $2,000 a month housing payment to a $1,300 a month housing payment. I'm up $700 just by doing a HELOC. Right? Think about that. That's money that I can save now. Now, the HELOC, as I pay into it, it reduces the principal balance, which also reduces my interest. This is called daily average balance. And then the annual interest is annual simple interest. Okay. Now, the biggest difference again between these two loans is a mortgage is what's called an amortized loan, meaning that I'm forced to pay principal every month. Principal and interest, taxes and insurance, PITI, that's what's on my mortgage statement. So the bank basically is saying, we want more of your income every month. We want it locked in. We want it guaranteed for the next 30 years. That's why they sell a mortgage. The mortgage was actually invented in the Great Depression, right? The mortgage we know today, the 30-year traditional mortgage. Okay, so it's very outdated. And the idea was for banks to get more cash from the consumer because banks were in a bad spot, right? Now, today, banks are still in a bad spot, but they get bailed out and they get bailed in and all this other stuff that makes it to where the bank's going to be fine no matter what. We don't have banks going under like we did in the 1930s. Okay, so what we have here is on the HELOC, it's not principal and interest, it's interest only. You notice this says PI, principal and interest for the mortgage. The HELOC, it just says I. Only interest. I'm only making the interest payment. That interest payment is about a 4% rate, right? So 4% of $400,000, if we take that onto a monthly basis, is about $1,300 a month. That's where that number comes from, right? Now, a daily average balance means if I pay money into it, remember we said it's a two-way loan. I can pay money into it. I can pull money out of it, right? So when I pay money into it, they're going to take the average balance of outstanding principal on a daily basis for the month. So they're going to look at it every day for 28 days, and they're going to say, what was the average outstanding balance per day? We're going to take the average of that on a daily basis. We're going to take it over the monthly period, average it out. That's what the balance will be, and that's what we're going to calculate the interest on. Okay. So what I'm saying is if you deposit income into a HELOC, direct deposit, and you leave it there all month, you're reducing your daily average balance. Right. So instead of using a checking account, which is with the bank anyway, so we're not telling you, like do something drastically different. You're putting your money in a checking account, which does not help you. We're going to tell you do a HELOC, deposit all your checks into that instead. What that does is it reduces your daily average balance, which means when they calculate your annual simple interest only payment of 4%, it's going to be on a lower balance because you've been having that money sit in there, however many days a month it's there before you pay your bills. And that reduces your average balance. Right? So when we do that, we actually show the average minimum payment throughout the life of this HELOC is actually about $700 a month. It starts at $1,300, but because we're making direct deposits into it and we're doing that daily average balance reduction, it actually comes out to an average minimum monthly payment of $700 a month. So initially I saved $700 right off the bat, but what I'm saying is over the long term on a mortgage, 30 years into it, your final payment on a traditional mortgage will still be that $2,000. Right? But on a HELOC, your minimum payment goes down to $700. You're now saving $1,300 a month. That's the average, which means it's higher than that at one point and also lower than that at one point, but it averages out to about $700 a month minimum. Okay. So if we look at the basis of this, right, we have total housing costs with a mortgage, $3,400 a month throughout the life of the mortgage, right? Traditional, conventional 30-year mortgage with a fixed interest rate of 4%. Okay. Or we do the HELOC, 4% interest only with the daily average balance system. We run the method we're going to talk about today. And based on that average of $700 a month payment, and then the same $1,400, you're still going to pay taxes, insurance, utilities, all that stuff's still going to happen. So it's still going to be $1,400 a month extra, but 700 plus 1,400 is only $2,100 a month. Okay. Which means that I saved $1,300 a month over the life of this mortgage just by doing a HELOC. right? So check that out, 1,300 bucks a month. That means that my savings to income rate, because again, this is based on an $8,000 a month income, net income, my savings to income ratio increased by 16%. $1,300 a month represents 16% of 8,000. Boom, I'm automatically saving 16% more of my income by doing a HELOC because I reduced my housing costs. Right? So we scroll back up, the purposes, we just covered number one and number two. They're boom at the same time. Housing went down, savings rate went up just because of that slight difference. Okay. So check this out. With that money, right? So we now have 1,600 or 16% increase savings, 1,300 a month. If we take that money and we take the same 30-year period, because remember, we're comparing this against the mortgage. We were going to have the mortgage for 30 years, probably longer because most people never pay it off. They treat it like a used car. They sell it every 5 to 7 years and get a new one. But let's say you were smart and good and you kept the house for 30 years and paid it off on your conventional mortgage. Same 30-year window, okay? That and you just leave it in your separate account. You're just making 4%, nothing crazy. You have made $902,264, right? $902,000. Best case scenario was that you would have kept $720,000 by not making more mortgage payments, by not because you paid it off early. What I'm telling you is right off the bat, by doing the HELOC instead, you're going to have $902,000. Now, I went to Houston High School, right? So I'm not a math genius. 62 kids in my graduating class. I was a C average student. I didn't go to college, but I know for sure $900,000 is more than $720,000. Okay, and I know for sure 4% is what I can make in a life insurance policy. And I know for sure that a HELOC does reduce my housing costs. Now, we never use the G word, guaranteed, like nothing is guaranteed, not even your mortgage. They can call that anytime and tell you to pay out early. But logic, and if we assume all of these things do actually happen, this would be the case. You would actually have $902,000 on just your housing payment, right? But that's not what we teach. We just insurance, you can build it up. Eventually, you want to start building for. So we invest this $902,000 for passive income. That is going to give you $9,006 a month. Okay. I'm hearing my audio is bad. Lexi, can you my audio and let me know if it sounds okay? So this is going to give you $9,026 per month in passive income. Okay. That's no small amount of money. That's more than the average in retirement. So when you consider that, that's a big deal. That's not something to snuff your nose at. That's not something to say, hey, this is that I should write off, or this is something that's too risky. We're saying you're going to have $902,000 and $9,000 a month in passive income. This is more than most people get when they retire. Okay. Just real quick, I want to check on the audio. I haven't heard anything yet. Is the audio better? Can you guys hear me now? Okay. Is it okay though? It's working? Good. So audio sounds good apparently. So this $9,026 a month is just on taking the housing payments that we've saved and investing that with the life insurance and putting that into private lending deals. And that's what it produces. Now, step number 3, like we talked about, was building passive income. We talked about this a little bit already, right? But the house itself is going to appreciate. So if we take a $400,000 property, we assume a 4% rate of annual appreciation, which is very standard and very normal over a 30-year period. This tells me that in 30 years, my house, instead of being worth $400,000, is going to be worth about $1.32 million. Okay. So in addition to the $902,000 that I have just from taking my savings and investing that and growing that and building passive income, in addition to that, I am going to have about $1.3 million in actual like increased value of my house in 30 years, right? Now, $1.3 million is easy to invest because I can invest as long as I have 50,000. So if we take 50,000 and we say, how many times does 50,000 fit into 1.3 million? 50,000 happens 18 and a half times, which means over a 30-year period, I'm going to have 50 grand to invest 18 and a half times over that period of time, right? Now, that happens every 19 and a half months. If I take 30 years and I divide that by 18 and a half, That means every 19 and a half months, I'm going to be able to invest my 50 grand, right? That's substantial. That's every year and a half. I've got $50,000 to do another deal. In addition to the 902,000 that we just talked about. So if we take this assumption, we say, let's say we actually do this every 18 months, every year and a half or so, my equity goes up. I have 50 grand. I refinance that 50 grand out through the Heloc, pulling the money out of the line of credit, investing that for passive income. If I do that at a 12% yield, which is very reasonable on a good private lending deal, I'm going to be making $500 per month per 50,000 that I do that with. Okay. We just said we're going to do 18 and a half of these. So $500 a month times 18 and a half gives me another $9,250 a month in passive income. Okay, think about it. We just said like the first one was 9,000. We're saying now it's another 9,000. That's over $18,000 in passive income in 30 years. Okay, this is not putting your money in a 401k. This is not paying the house off. This is not giving it to Wall Street. This is borrowing, doing a home equity line of credit, investing the difference, pulling out all of your equity as your house appreciates, and continuing with that cycle. Okay. So that's the math that we get. This is not including reinvestment, by the way. Like that $500 a month you're getting, that's also going to go in direct deposit into your home equity line of credit. That's also going to reduce your daily average balance. That's going to compound and stack up and get reinvested. Right. So we look at that, which I don't have a calculator that does that dimension, but you can guess like, all right, $500 a month times 18 and a half is 9,250, right? I know 9 times 5 is 45. So we could say probably in 6 months, I'm going to have enough money to do another deal. So now I'm doing a deal every 19 and a half months just on equity. Okay. I'm doing deals with my savings on the mortgage. And I'm also doing a deal every 6 months or so with just the cash flow that I have coming in from these deals. That's 3 different tiers of deals coming in. Right, guys, that's substantial. That's incredible. And that's how you build passive income from a house. We're not talking about renting. We have said nothing about tenants. This is just you doing the mortgage with the strategy that we've talked about tonight and implementing that correctly, right? Number 4 is a tax deduction. I can deduct my interest on my taxes. Now, the problem with interest is a lot of times it can be capped. We have the standard deduction, right? So if we're itemizing our interest deductions, we have to have a really big mortgage payment to actually be able to deduct our interest and get any reasonable benefit from it, right? But if you're doing the home equity line of credit and you're using it as an investment, you can actually take your mortgage interest and per Internal Revenue Code section 163, you can classify it as something called an investment expense. In other words, it's the cost of doing deals, right? When I do this deal, sure, I make 12%, but I have to pay interest to borrow that money. That interest is now tax deductible as a business expense, not as an itemized deduction. I'm not doing itemized. I'm writing this off as a investment expense against my investment income, which means I can write off 100% of my mortgage interest costs associated with those deals. I can't do that on a conventional mortgage, right? Not only that, but I also am harvesting tax-free equity, right? So if we go back to this example of my home appreciating, I have a $400,000 house over 30 years that appreciates to 1.3 million. If I am married, there's an exclusion on the first $500,000 of capital gains, meaning if I sell my house, I don't have to pay taxes on the first $500,000 on capital gains, right? So I paid 400,000, which means up to 900,000 if I sell this would be tax-free. Sorry about that. We just had someone call. Lexi, can you come switch the do not disturb on the camera here? So we have the first 900,000 of equity that's going to be tax-free, but beyond that, that's about 400 grand that I'm going to have to pay taxes on if I traditionally sell this property, right? So the way that I avoid this is I never sell the property. Just swipe diagonal down. You got to go diagonal. Just a second, guys. We're working out some technical difficulties. Go diagonal. There you go. The little moon there. Cool. Awesome. So we're talking about having $900,000 that we get tax-free on a sale using the capital gains exclusion, but still having to pay $400,000 capital gains tax on that $400,000. But if we're borrowing against it and never selling, right, we get tax-free equity. We don't have to worry about paying taxes. Right now, they're moving the capital gains rate up to about 25%, which means on $400,000, I'd pay $100,000, right? So check this out. We have the tax-free equity, and then we also have, and this is not using the mortgage, this is just icing on the cake. We help you then use the house to get tax deductions, right? We can use a couple of different ways to get accelerated depreciation on the house. We can use something called the Augusta rule. These are all things in the tax code that my team knows that as a client of ours, you're going to get as a benefit as well. So these are additional tax deductions you can get for using the house itself for business. Okay, so that's all the tax stuff, right? So I want to make sure we understand the basis of what we're talking about and the potential of it. Next, I want to answer the question of where do we actually start, right? Now, there's going to be two different parties here. There's going to be people purchasing a house, right? New purchases, and those refinancing, people that have an existing loan. People that have an existing loan, they're refinancing the property into a HELOC. Okay, I want to start with the purchases. If you're purchasing a home, first things first, on a home equity line of credit, you need 10 to 20% down, right? Most loans are going to say 10%, which is a great. Some are going to say 20%. Now, we're actually going to save this 10% in gold. And I'm going to tell you why. If we take cash and we buy a house with the cash, what we're saying is 10% of this loan we can never borrow against, right? Because that's the loan to value. We can only borrow 90% loan to value ratio, which means there's 10% of money that we're putting into this house that we're never going to see a return on, right? It's kind of like paying off debt. It's like taking 10% and paying it towards debt. We're never going to see that money again. We'll never see the future value of it. In this case, you will when you sell the property, but that's not the point. We're saying keep it forever and just continue harvesting out the equity, right? So by putting this in gold, you're looking at, okay, I can now borrow against the gold. I'm going to take 10% down payment, put that in gold, take a loan against the gold, use that as the down payment on the property, right? So we're borrowing against it, making the down payment on the property for the HELOC, which is step 3. And then step number 4 is I'm immediately then reducing my housing cost by doing that, okay? That initial reduction in housing cost, I'm going to use to pay back my gold loan. So in this case, we reduced my housing cost initially by $700 a month. So that's $700 a month, boom, I'm funneling that back towards my gold loan. Why are we doing this? Because over the long haul, gold averaged about 8% since 1971 when it became legal to own again, 8% a year, right? So what that means is by doing this in 30 years, my initial 10% down payment, which would have been 40 grand, right? $400,000 house, we put 10% down. That 40 grand would have turned into $437,000 just by using that gold system. I would have paid the loan off very quickly, right? And then the gold continues growing. Now I can still borrow against it and do other things with it. But my point is we're keeping the future value of that down payment instead of getting rid of it by putting it into that, cash and then putting that towards the down payments and then never seeing the money again. I would rather have it in the gold. I would rather have that down payment working for me, right? So I want to make sure I didn't lose anyone here. Save 10% of your down payment in gold. Use the gold to borrow against, make the down payment, get the HELOC, then take the new margin, the savings that we have on reducing that housing payment, pay the gold loan back. Once the gold loan's paid back, we're good to go, okay? Step number 5, right? We covered paying the gold loan back. Step number 6, we do direct deposits into the HELOC. 100% of our paycheck goes directly into the home equity line of credit, right? 100% of it, we're doing direct deposits. So we're not using a checking account anymore for this. We're telling our boss, here's the routing number for my bank. Here's my account number, which is actually your HELOC. And then that money goes directly into the HELOC, reducing the daily average balance like we talked about. Now, the other factor on this is 100% of your expenses should be made on cash-back credit cards. Now, this is not for someone that has consumer debt. This is not for someone that's had bad problems with credit cards. This is for someone that is solvent. They're creditworthy now. We've fixed them up. They've learned their lesson, and they're going to pay their card off every single month in full. No excuses, no reasons why they didn't. Just boom, every month before the statement close date, that card gets paid off in full, right? What that does is that we're getting cash back, which is usually going to be like 2 to 5%. That's giving us extra money because now every time we make a payment for our bills, we're getting cash back. Okay. So all of our income goes into the HELOC. All of our expenses go on the cashback card. Why don't we take the expenses out of the HELOC? Because then it reduces the daily average balance. We want the income sitting in there for the longest period of time so that that balance gets reduced and so our interest gets reduced. So once a month on our statement close date, boom, we take the money from the HELOC, we pay off the credit card, we're done, right? We maximize our interest savings on the HELOC And also we maximized our cashback rewards on the credit card. So we're now double dipping. Okay. Now, in addition to that, we have 40% of it coming out, going into our sacred accounts. We're saving for our liabilities as well, things like car purchases and taxes and different things like that. We're not doing any of that in the HELOC. We're taking that out. We're putting that into our tier 1 sacred account, life insurance, right? So my point is we're not using the HELOC as a savings vehicle. Like I said, we're not trying to pay the house down early. We're not trying to accumulate cash in the HELOC. We're trying to reduce our housing payment. First thing we're going for, the daily average balance does that. Using the credit card does that. We're still going to pull everything out at the end of the month, and we're going to leave very little to nothing inside the HELOC at the end of the month. Okay. So step number 10, we pay the credit card off in full before the statement close date. We talked about that. Step number 11, as soon as our house has appreciated by 50,000, we go back to the bank. We say, increase my credit line. I want to get a maximum increase on my credit line. I'm going to pull the 50,000 out. I'm going to invest that. I'm going to get $500 a month for that 50,000 and direct deposit that $500 a month back in. So that's step number 13, invest for passive income. And then we repeat number 6 through 13. Every single time we do that, all the income goes back into the HELOC. All the expenses go on the credit card. We continue saving. We continue building up our assets. We continue paying the credit card off. Next 50,000 in equity that we get, boom, we go back to the bank and say, increase my line. Let's do it again. And you continue doing that over and over and over. And you never actually stop until the bank says, hey, we can't increase your line anymore, which I've not seen happen yet, right? Is the housing market goes up, so do loan limits, right? Step number 14, and this is a question mark, meaning you don't have to do this, but you can. If you've lived in the property at least 2 years, you could move out, keep the house, keep the HELOC, and then rent the property out, right? If you do this correctly, you can sell this to an S corporation, get the capital gains exclusion, still keep the HELOC, but now you have a gigantic depreciation you can write off against your taxes. Okay, so there's other things you can do at the end of this. Now, if you're refinancing, it's almost the same steps, right? You're obviously not buying a new property, but the first thing is if I'm refinancing an existing loan and that existing loan doesn't have at least a 90% loan to value, then I'm going to buy enough gold to be able to borrow against and pay it down to 90% loan to value so that I have 10% equity minimum the entire time, right? So then I'm doing the same thing. I'm borrowing against the gold. Step number 3 is a little bit different. Instead of making a down payment, I'm paying down the existing mortgage to 90%, and then I'm refinancing into the HELOC. But the rest of these steps are all completely the same. Nothing changes after that point, right? So this is exactly step by step, all the way down to the bottom. Now, the result of this, right? Because this is different. It's new. It might seem complex. If it's the first time you're seeing it, it's like, man, Jerry went really fast. I'm gonna have to watch this again, right? Guys, that's because the mortgage is easy. Everything that's bad for us is easy. The mortgage, super easy. Auto enrolling in your 401k, super easy. Getting a credit card, super easy, right? Getting pharmaceutical pills from your local drug dealer, super easy. None of those things are good for you. Not going to the gym, super easy. Being financially literate, way too easy. So we want to actually look at, okay, this is not easy. Why? What's the benefit? Okay, because I'll tell you what, when people like Robert Kiyosaki and Grant Cardone do real estate deals, they're not doing traditional mortgages. They're doing 10-year interest-only mortgages. That's what a HELOC is. It's an interest-only mortgage. We want to mimic what the wealthy do. When banks lend to each other, they do not do amortized mortgages where they make principal and interest payments. They do interest-only mortgages. They do interest-only loans between them. Okay, they want to be able to service the debt and then refinance it and get more debt, right? And with this, you're always backing it with equity. We're not just borrowing money back by nothing. We're saying, no, we've got equity in the house. We have a safe position. A bank actually looks at a home equity line of credit as a good asset on their balance sheets, right? So back in 2008, who remembers in 2008 when they froze all of those lines of credit on people's homes? Those were not first position. Those were second position, meaning, John and Sue already had a mortgage. And in addition to the mortgage, they also then added a second position HELOC on top of that. And so the banks look at that and they panic because they're like, man, if John and Sue can't pay, the mortgage is going to be the thing that forecloses. We're going to get left high and dry. We're telling you here, you don't have a mortgage. The bank has nothing to worry about. They would prefer this, right? It's a lower payment. It's a higher equity value for them. There's not a first or second position problem. They're first position and they're fine. And they know you can make your payments. And you have a very low debt to income ratio and a very high savings rate. Okay. So what is the result of this? Why would we actually do this? Here's the result. We reduce the housing cost immediately on this mortgage compared to the mortgage by 30 to 50%. Okay, 30 to 50% is substantial, and we're not downsizing. This is the same house. This is not, you going and living beans and rice in some crappy little studio bedroom apartment. No. Same house you got now, but you're doing the HELOC instead of the mortgage. And because of that, your housing cost goes down 30 to 50%. Okay. You are immediately saving 15 to 20% more of your income. That's the second thing. Third thing is when we count it all up between the passive income we get from the housing savings themselves, the passive income we get from harvesting out the equity, the passive income we get from investing that gold loan that we did for passive income, we have $22,650 a month in passive income at the 30-year marker. Okay. $22,000 a month in passive income. Remember at the beginning, we said best case scenario, you pay off your mortgage. Cute. You save 720 grand, right? Or $22,000 a month in passive income for life. Which one is better, right? And then we also save about $500,000 in taxes between the cash outs we'd have on the home, the deductions we're getting on the mortgage, the different tax benefits we're getting on using the property correctly for business expenses. This is going to total up to about $500,000 in tax savings over that 30-year period. We also then have about 70 grand in cash back rewards from our credit cards over that 30-year period, just by getting, 3, 4, 5% back on all of our expenses. And then in addition to that, we've got over $2.2 million in real assets, not including the home, right? We're talking about investment deals. We're talking about gold. We're talking about things that actually are going to produce for you, right? So I want you to think about that compared to, okay, I could pay off the house and I could have $720,000 in my pocket that I save by not having to make mortgage payments. That's cute. You still have property taxes, or 22 grand a month in passive income and over $2 million in assets. Which would you rather have? And if you understood the math tonight, you know that this is very doable. This is not by any sense of the word a stretch of the imagination. These are very reasonable numbers. I have several clients watching right now that they make 12% on their investment deals with us, month in and month out. It happened during COVID. It happened before COVID. It's happening after COVID. Right? We have clients that have owned real estate that can tell you their house has appreciated 4 to 5% every year. I have clients that have done the HELOC and they can tell you, yeah, my interest on my house is about 4% interest only, and my payment dropped and it's only 30 to 50% of what it was. Right? These are all real things. So this is basically what could happen if we do all this correctly, right? This is not including the other blueprint to financial freedom phases. This is not including you doing the 40% rule, saving 40% of your income. That's separate. Investing that money, that's separate. Doing, sophisticated investments and accredited investments, that's separate. Tax planning, that's all separate. We're saying this is just the house, guys. This is just you doing a home equity line of credit, none of the other blueprint steps, right? Now, in reality, you know that we're not going to let you do just this and none of the other blueprint steps. So you have to do all of them in sequence. There's a reason why we have it set up that way. But I'm telling you, imagine all of the other stuff now. Imagine you're doing this and saving 40% of your income and investing that for passive income and doing our tax planning stuff and doing our sophisticated and our accredited deals and working the arbitrage strategies that we talk about and doing all the credit stuff we talk about. All of that combined with this, you can see how people get in the top 1%. Guys, I didn't tell you to buy Bitcoin and speculate tonight. I didn't tell you to go buy, whatever hot stock and hope it goes up or day trade. Anyone could do this. If you have a good credit score and you have a positive cash flow in your budget and you have, enough equity in your home to make it happen and the discipline to actually educate yourself and study and follow through, anyone can do this, right? And that's what I love about the strategy. There's no luck involved. There's no market timing involved. There's no being an early adopter and getting in and out at the right time. No. You can be a dumbass from Houston High School with 62 kids in your graduating class, C average student, no college degree, and figure out how to do this, right? Now, I told you guys at the beginning, I can't do this. Now, let me talk about why, because again, this happens in sequence, right? When you do this in sequence, this is on blueprint step 2C, right? This means it's happening before we do advanced tax planning. If you do advanced tax planning before you do a HELOC, you're reducing your taxable income, which is what I did. I've never had to pay much in taxes, if anything at all, because I've always known the tax code. I've always known how to reduce my taxes as a business owner and as an entrepreneur. The benefit of that is I keep all the money. The downside of that is if I go to a bank and I tell them I want to qualify for a loan, they say, Jerry, show me your tax return. Guess what? It shows I made zero. They're not loaning to zero, right? So the tax planning we do after the HELOC. There's a reason why this is phase 2C. Tax planning is 2D. If we do the tax planning before the HELOC, then you're going to have the same problem I have, which is you're going to march into a bank and they're going to say, we need 2 years of income statements, and you can't show them anything because we figured out how to hide it all from the IRS legally. They don't care. They just want to see your W-2. They just want to see your tax statement. They want to see your adjusted gross income, and you can't show them anything other than zero, right? Or you show them 1 year, like before you worked with us, where you made 300 grand or 400 grand or 100 grand or whatever the number was. And then the following year, it went down to like 20 because of tax planning. And they're like, why did you go from 100 to 20? That's worrisome, right? So I want to share that because from a transparency standpoint, like if you haven't done advanced tax planning, do the HELOC first. That's the reason why we have it there, okay? Now, why wouldn't someone do this? Let's talk about that. Why would someone, look at this and not do it? Number one, they don't know anything about it. The majority of the country will never find out about this. Okay, I have a good friend that owns a company that specializes in HELOCs, and he will tell you a real story of him and his client going to a bank, and he told his client, go to the bank, ask for this exact product. Okay, so he goes to the banker and he says, I want the home equity line of credit. The banker has no idea what he's talking about. Like literally no idea. Like the guy that he sits in the office with that helps him with the mortgage, it's like, I don't know what that is. That's not a thing. Like, are you sure it's not called something else? So he goes back to my friend that owns the HELOC education company and says, hey, the bank doesn't know what I'm talking about. And he says, hey, I want you to go and I want you to talk to the president of the bank, the main guy, the guy in charge. Ask him, he'll know. So he gets a meeting with the main guy in the bank, like the president of the bank, and the guy sits down with them, the executive, and he says, hey, I know exactly what you're trying to do. I understand what it is. We do offer it, but I won't sell it to you. Okay, this is the guy that runs the bank. This is a real story telling the client, I will not sell this loan to you. I won't tell my people that it exists. I'm not going to let them sell it to you. The client asks why, and the bank says, because we don't make enough money on it. Right? We don't make enough money to sell you a home equity line of credit. It's not profitable enough for us to do. We would rather sell you a conventional mortgage. We would rather get more of your income for 30 years and get closing costs and all this other stuff we get on a mortgage that we don't get if we sell you a HELOC. Okay, so it's sometimes our fault that we don't know about it. Sometimes it's not our fault. Sometimes we could know about it and we don't know who to talk to and how to say the right thing and ask for the right thing. This is very similar to the sacred account with life insurance. If you go to 99% of insurance agents and you say, I want to get, life insurance I can borrow against, they're going to sell you the wrong stuff. And they're going to think they sold you the right stuff. Okay. Out of all the life insurance policies that have cash value, only about 6% of them ever get borrowed against, which means the other 94% aren't designed in a way where the people know how to do it. Okay. So that's the second thing is this, they simply don't know how to do it, right? I might know about it. It might be a thing I'm aware of, but I might not know how to do it. It might be something where I'm like, how do I execute on this? Okay. This is why we have a service for this. You don't just go to the bank and hopefully you get the right product. Guys, the bank is not your friend. If they're federally chartered, they are a member of the Federal Reserve System. They are a shareholder of the central bank. They are not your friend. They have equity in you doing poorly financially. That's how they get paid. Okay. So if you go to the bank on your own and you don't know how to do this, just like the story I told, you're not going to get the right thing. Okay. Number three, they don't know when to do it. They know it's a good idea. They know how to, but they don't know when to pull the trigger. Like I talked about the tax planning, right? Like there's a sequence to this. There's a reason why the blueprint is laid out the way it is. Guys, I've been doing this for 10 years. I've been studying top 1%ers. Like this is something I eat, sleep, and breathe. There's a reason why all this is organized the way it is. And so we give you the answers on, okay, do this first, then do that. Then do that, then do that, then do that. Then do the HELOC. Then do the tax planning. Okay, so that's all very specific. And then number four, they might know about it. They might know how it works. They might know when to do it, but they might not understand the math. Excuse me. They might not understand the math. They might look at this and they might get confused. And this is, again, where you need someone helping you. If you don't understand the math, I love math. I very easily, I get it. It's something that's easy for me to grasp. I know some people that they love art. They're not good at math. Doesn't mean they're dumb. It just means they're better at art than math. I'm terrible at art. I lived in a house literally for 2 years. And the day we moved out, I noticed the paintings on the wall. Like that's me with art. I can't do art. You can't do math. That's fine. We can help you with the math. No worries. Right? So they might not understand the math. Number five, they're generally afraid. Right? Some people are like this. They operate in fear. They know the math makes sense. Okay. They know when to do this, they know how it works. They know why it works. They know about the strategy, but they're afraid to pull the trigger. Usually it's because they're involved with the banking system. They're suppressed, right? They're so into the Wall Street and the bank and the IRS that they're afraid to do anything different. They're afraid of what will happen. They're afraid of what their friends and family that are also suppressed by those groups, what they're going to think of them. And so they can't make a move because they're afraid. Okay, so that's one of them. And then finally, number 6, their goal is safety instead of freedom. Right? Like I can show this whole presentation to the wrong person tonight, and they're still going to say, nope, I'd rather just pay off my house. I don't care. It's only 720 grand. I could have made millions. That's fine. I don't care. My goal is not financial freedom. My goal is to have a paid off house and be comfortable. Right? Like we talked about, guys, we are breaking out of financial prison. This is Shawshank Redemption. Right? And there are people that could have gone with the guy in Shawshank Redemption. They could have broke out with him. They didn't because they were more comfortable in the jail yard. Even though they weren't safe, even though their quality of living was terrible, even though they got the shit beat out of them day in and day out, it's more comfortable because it's what they know and what they're familiar with. Okay. So there's some people that's their thing. They don't care about freedom. They're just tunnel vision on safety and comfort. And that's fine. Those are not the people we try and help. Right? Everyone's got to have their moment when they realize, oh crap, I'm in prison. This is not safe. I need to get out, and they have urgency with doing so. And if they don't have that, it means that they lack the financial literacy level to actually be at that stage yet. Okay, we can't force financial literacy down someone's throat. They have to have a moment where they're like, oh, this matters. What I've been doing isn't good. It hasn't been working. I need to change it. Okay. So action steps. What do we do here? Okay, and I'm going to wrap up after that. What do we do? The first action step and the only action step is get to phase 2C on the Blueprint to Financial Freedom. Again, Blueprint to Financial Freedom is my book. I wrote this and it breaks down step by step. There's a chapter on this exact strategy, but on phase 2C is where we actually do the Heloc. Okay, we don't do it before, right? We don't do it in the middle. We do it at phase 2C. And Nano's saying make a sprint there. Guys, you don't have to take a long time on this. Some people do, right? It's like I related to swimming through like a cesspool. Your goal is to get from one side to the other as quickly as you can, right? Sometimes we get tired in the middle and we're like, man, this poop doesn't smell so bad. And we're like, I can float on my back and it's actually kind of relaxing. And then we find a little island in the middle and we pitch our tent and we just live there. And it becomes our new home. And we forget the goal was to sprint, to get to the other side, to swim as fast as we could. We forgot that and we turned it into our house. So what I'm pointing at, what Nano is saying is get to phase 2C quick. Okay, it doesn't have to take years. If you push and you get creative and you commit, it can happen quickly. So guys, that's all that I have for you tonight. What I want to do is I want to open this up for questions. So if you're watching this, if you're on Zoom, we will go live. So drop your questions in the chat in Zoom. We'll go live and talk about them. Make sure that they are related to this topic tonight. If you're on Facebook, drop your questions in the comments. We'll read through those. I'll answer our Facebook questions first, and then we'll go through here on the rest of them. All right, lots of good stuff on Facebook. Justin, good to see you. Jazwan, good to see you. Sean, good to see you. Justin says, perfect timing for me. That's awesome. I have actually a couple clients going through this Heloc process, and that's why I chose to do this course tonight. So that we've got a handful of people that this is what they're focused on right now. And so I wanted to give this to them. Brad says, great strategy. Brad is one of our success stories with this. He can attest that this is something that works. He's done it himself. It's a great strategy for him and his family. Josiah says, going to turn my house into a giant piggy bank. Love that. Justin Goff says, you did this call just for me, didn't you? Justin, you were one of the handful of people that I just mentioned. Okay, Justin has a question. Would my sacred account premium also be deposited into the Heloc with my income, then automatically withdrawn from the sacred account? No. So Justin, what would happen is all your income goes directly into the Heloc. And then once a month, your sacred account is going to come out, right? So I would take that out, the end of the month. So you have the money sitting in the Heloc for the most amount of time. And then once a month, you're going to pull that out and put that into the sacred accounts. And then they're two separate things. You're not going to borrow against one to contribute to the other and back and forth. It's not that kind of strategy. Direct deposit to the Heloc, boom. Then once a month, move it into your life insurance. Daniel asks, would you tag the 50K from the Heloc to the sacred account or just extract the 50K from the Heloc into a deal? That's a good question, Dan. I would go directly into the deal. So what Dan is saying is you have 50 grand in equity in this Heloc. Do you pull it out and then put it into your life insurance or buy gold with it and then also borrow against that asset before you invest it? I don't do that. I wouldn't recommend that. And the reason being is now you have to pay 2 loans back, right? So if I borrow from the home equity line of credit, that's a loan. And then if I put that into the life insurance and borrow from that, that's also a loan. And so now I'm in a position where I've either got to split my payments between the two of them, which is going to reduce my overall progress on paying it back or paying it down, or I've got to pay it into the life insurance, then borrow from the life insurance to pay back into the HELOC, which kind of negates paying it into the life insurance in the first place. So I wouldn't do that. I would just go straight HELOC into a deal, take the income from the HELOC, direct deposit that back in, right? From the deal you did, put that back into the HELOC as a direct deposit. Then you can fund a sacred account with the income from it after that point. Jazwan says, thanks to the WXT, I'm happy to report that today I got pre-qualified for the HELOC with all the bells and whistles and pre-closed on my first newly built home. Boom. That is freaking awesome, Jazwan. I also got my life insurance and my gold sacred accounts, fixed my credit with Wealth Dynamics, and now I'm using gold for my down payment. I can attest that this strategy does in fact work. Jazwan, I can't tell you how excited I am for you, man. We got to celebrate. That's awesome. And guys, Jazwan, he's a staff member and a client, but he's someone that found us in like February or March of this year, right? So Nano's saying this does not have to take a lot of time in May, right? So May, June, July, August, September, October, guys, that's 5 months. 5 months, just one has gone from phase 0A to phase 2, right? You just did 2C. That's not 2 years. That's not 6 years, guys. That was 5 months. Okay. Anyone can do this. I'm telling you. Only took me 6 months to go from deep in debt, phase 0 to phase 2. It can be done all in the name of financial freedom. Guys, that's what this is all about. Like, this is all about financial freedom. That gets me freaking pumped. Josiah asked, do HELOCs have a time frame to them? Your example was against a 30-year mortgage. Do HELOCs have an end date? That's a good question. So Josiah, most HELOCs are going to be a 10-year term, meaning your line of credit is open for 10 years. At 10 years, at 10 years, you either need to refinance or you need to pay it off. Right now, my opinion is that you're going to refinance sooner than that. Like we talked about, every 19, 20 months or so, you're going to have 50,000 approximately in equity to strip out, which means about every year and a half you would refinance, which means every year and a half you're resetting that 10-year window. And so it never really becomes a thing because you're always opening up another one, right? And your finances are improving, your income is going up, your savings are going up, your asset values are going up. So every time you go back to the bank to ask for more, your financial statement looks better and better, right? So that's what I would point out there on that question. Very good question. Let me see what we have on Zoom here next. Man, I'm just so pumped about Jazwan's story there. That's phenomenal. Okay, let's see what we have for questions on Zoom. We've got Mark, good to see you. Joseph, good to see you. Nano says pledge to death equals mortgage. That's what mortgage means, the etymology of that word. I hope the audio fixed up. It looks like it did. Okay, I think Nano has a couple of questions. Nano, go ahead and pop on live here. We'll answer your questions.
Hey, Jerry, what's going on, man?
I'm good, man. How are you?
Doing good, man. Thanks for asking. So I have a few questions. Do you want me to go give you one and then you answer, or do you want me to give everything?
Yeah, let's just go about one by one, or I'll forget the first one by the time you tell me the last one.
Okay, cool. So first question is, how is this beneficial to the bank to have me pull the money from the HELOC? And is the money pulled to be used for arbitrage investing to then repay the HELOC back? That's the first question.
Yeah, so it's beneficial from the bank because you're making interest-only payments to them. So they're making, on our example, $400,000 home equity line of credit. They're making $1,300 a month on that. And so these are typically going to be smaller regional banks. So a lot of times they'll be state chartered instead of federal chartered. And so they don't have the same, the same government loan programs and firepower that like a giant, JP Morgan Chase or a Bank of America might have. So this is kind of their sweet spot. This is their niche. They have good clients, good persistency, good income, and they know it's a quality asset. And then you asked, what was the part about the arbitrage?
Yeah. So whenever the money it is pulled out from the HELOC, is it going to be used from an investment and then you have an investment that's producing you income to repay the HELOC back?
Yeah, exactly. That's exactly it. So when you pull out the first 50,000, if you think about your cost on that 50,000 is 4%, right? So 50,000, that's 500. I think that comes out to like $2,000 a year. So you're paying like 180 something dollars a month in interest cost on that 50 grand, but you're making 500, right? So that 500 covers the cost of interest, but it also goes in and it pays down the principal So you're kind of servicing the loan and also reducing the balance, very similar to the life insurance.
And also that can be used, you explain here in a way that can be written off as a depreciation on your taxes.
Yes, you can write off the interest if you use it for investing. You can use that as investment expense. And then there are tax strategies to write off the depreciation.
Okay, good. So the following question is there any major difference between using the Sacred Account Tier 1 life insurance versus the Sacred Account Tier 2 Gold for the down payment? Or we're just simply mimicking what the banks are doing?
So you could do either one. You could do the tier 1 with the life insurance for your down payment. You could do tier 2 with the gold. I'm personally more aggressive. And so I know over the long term, gold is going to have a higher annual rate of return than the life insurance. So I'm okay with the volatility that comes with gold. Like we've talked about, gold has about a 15% standard deviation, meaning it averages about 8%, but it can do 15% more than that or 15% less than that. And that's considered a normal range. Right. Whereas life insurance, the main difference is going to make me 3 to 5%. It can never lose, but it's also never really going to do more than that 3 to 5%. So I love it for my reserves. I love it for funding things like vehicle purchases, paying taxes, doing the liabilities. Once I've funded it though, like something like the Heloc, I would personally prefer the gold, even though it's kind of your own personal prerogative on which one you do.
Okay, great. I mean, at that point, whenever you're in the position like that, I guess you have the luxury to be a little bit more aggressive at that point.
Yeah, exactly. There's a lot less to lose and a lot less risk on the table.
Okay, great. Thank you.
Awesome. Very good questions there. Let me see what else we have in our questions. We have a question from Jorge. Let me bring Jorge on live. All right, we're live with Jorge. How are you today, Jorge?
Good, good. Hey, Jerry, can you hear me well?
I can. Yeah. Can you hear me?
Yeah. Okay. I had a quick question. Do you have a preference when it comes to the Wall Street or the London rates when it comes to those HELOCs?
Yeah, that's a great question. So I don't have too much of a preference. So what Jorge is talking about is the interest rates on these mortgages will usually use an index or a benchmark. So there'll be like LIBOR, which is the international banking rate that's used. They'll use that as the benchmark plus like a margin of like 2.5 or 3%. I'm not so worried about the index as much as I'm looking at what's the actual gross rate, right? So if it's LIBOR plus 3.75, let's say LIBOR is 0.25. We take that, we add that to 3.75, that's 4%, right? So my thing is that more or less? Now, the other factor too is that they're actually getting rid of LIBOR. LIBOR is going to go away very soon, I think in the next year or so. So if you're using a LIBOR-based product, that's something that's going to get transitioned into a new rate or a new index pretty soon. So if you don't like the change, then maybe don't jump in on something that has LIBOR. But I think the rate's going to be about the same either way, regardless of the index in particular. Nano made a very good statement. Nano said banks sell the regular mortgage to us, but then they sell the mortgage to investors, right? The banks don't usually keep and service your mortgage. They usually do sell that to an investor. All right, Mark has a question. Mark, go ahead and drop your question in the comments first. My rule is I never do mystery questions because I never know what someone's going to ask until I can see it. Okay, Andre has a question. Let me bring Andre on live here. All right, we're live with Andre. How are you today, Andre?
Good, Jerry. How are you?
I'm good. Thanks for asking. What is your question?
Well, I'm trying to go through the same process soon. So I know with certain new construction loans, especially in our area, you have to put down like 10% before you really close on the home, and the new house bills are taking about 8 months. Mm-hmm. So, and I think with replace your mortgage, they're looking for you to at least have 20% down. Mm-hmm. So I was thinking is like, so with, leveraging the Go loan, would you, because I heard you say do 10%, would you do 10% from the Go loan and 10% cash? Because you won't be, the mortgage won't be lowered yet until you close and get into the actual house until the 8 months construction build.
Yeah, I got your question. So basically the answer to that is if you're doing it like that, you're going to do 10% like initially, which is actually what Juan just did. So he did 10% initially. He used the gold. I think in Florida, they're a little more lenient. So I don't think he's going to have to do 20% down. But his house is about 6-8 months out from being built as well. So he did 10% with gold. Boom, that's the down payment to the builder, right? So he's paying 10% to lock down the property with the builder. Then he gets, pre-qualified for the home equity line of credit. Let's say though, in theory, the Heloc said, hey, you actually need 20%. We'll only do an 80% loan to value. Then Juan would have to come to the closing table with another 10%. So that point, he would do another 10% in gold or from life insurance. The idea being is if you use cash, you lose the future value of that cash. So if it's 20%, you'd bring 20% to the table with the gold, whether that's, all at once, or if that's 10%, initially, and then 10% 6 to 8 months later. And then basically, at that point, you're doing it just in different time periods, but still it's going to be 20%. So just one says, yeah, 10% is all Florida requires. And I think that varies bank to bank. So Andre, I think in Georgia, we might be able to find out if it could be just a 10% instead of 20. All right, Joseph has a couple of questions. Let me bring Joseph on live here. Hey, Joseph, how are you tonight?
I'm doing well. How's it going?
I'm good, man. Thanks for asking. I see you got a couple of questions. What is your first one there?
Well, so we talked about this before. I've already, in the previous question was pretty relevant. So I've already committed basically to a pre-construction condo, and they required a 30% down payment. Mm-hmm. So I'm already kind of about 80,000 into that. And so I'm wondering kind of mid cycle if it makes sense to continue that, because I don't actually have, I kind of found out about you a little bit when I was already a little bit farther down the path, right? So I'm wondering kind of best scenario, best strategy going forward for that. If I should, like just kind of the best strategy for that, I guess.
Yeah. Are you asking like on handling the rest of the down payment, or are you asking like, is the house still a good idea?
Well, both rest of the down payment. And then also just given where, because I'd be doing a HELOC probably within the next, the down payment's going to be paid probably within the next 8 to 10 months. I got a 0% loan, or basically a seller financing, I guess you could say. Yeah. So they basically let me split up the down payment over 12 to 18 months at 0%. So I'm kind of just wondering what the best scenario would be on that.
Yeah, good question. So this is a little bit of a tough one because what Joseph was saying, he's kind of already in the middle of it. Like he's already started with the down payment process with the builder. If this was me, I would be looking at it. And again, everyone is different. I'm very unemotional when it comes to money. So I would be looking at, okay, do I have debt? Do I have my reserves built up? Do I have all my other prior phases done? If not, I would probably stop. And if I could get the money back on the down payment, I would. And I would say, great, let me just go pay off my debt. Let me take care of my reserves. There will always be more houses to buy later. So that's my thought on it, is that might be something to look at, is it might be too soon because that money going towards the down payment could be going to other things. So you always want to look at what's the opportunity cost of doing one thing over the other. If it's a situation where you're like, nope, I'm set on the house, this is my dream property, I'm going to do it no matter what. I think at that point, there's probably some other factors to look at on what assets are we going to be using for the down payment, or is it coming from income? And if we use those assets or that income, what are the other things that's taking away from, whether that be, again, taxes, reserves, debt, whatever those things might be. So I don't have like a hard and fast answer for you tonight, I think. And we talked a little bit about this. I think there's a couple of different scenarios we look at on, I think you maybe have some other assets you could collateralize that might work. And if that's the case, that could be helpful. But then also there's some prior phases we want to cover. So I think the tough call is almost looking at, okay, do I do the house? And if it's not a good idea, can I get the money back out of it? And if that happens, what does that do for the rest of my blueprint phases? And if I can't or won't or don't want to, then where's that rest of that down payment money coming from? And how do I do that in a way where it's not injuring my ability to, get out of debt, build reserves, those other steps that we'd be focused on at that point as well. Okay, I have a question from Mark. Let me bring Mark on live here. All right, we're live with Mark. How are you tonight, Mark?
Hey, Jerry, I'm great. Good show. Actually, a topic that I'm quite familiar with, and have been doing it for a few years now. I have two HELOCs, and I'm here in Hawaii, so we're in a unique position to where the local community banks are very competitive with the rates between each other. So we have very low introductory rates from 2 to 3 years, ranging from currently 0.99 for 2 years to 1.25 for 3 years. So I'm in two HELOCs, like I said, with introductory rates of 2.25, because I'm like on my third introductory rate pattern. But they keep on asking me for to refinance it at a fixed rate option at a higher rate and a longer term. Do you think that would be a better option, or just to keep on jumping from bank to bank to bank to get introductory rates to keep the interest payments or rates down?
I mean, it's kind of like I think the admin side of that is kind of up to you on how much of that you're willing to put up with. If you don't mind going through the underwriting process every 2 to 3 years and dealing with the banks, I think you're saving a lot of interest by doing it that way. I liken it to like using like 0% balance transfers on credit cards. Very similar what you're doing with the HELOCs. So the bank, of course, does want you on a longer term with a higher rate. If that's not necessary and it's not a requirement, and you could continue getting those lower intro rates and you don't mind doing the work of it, I think you're fine if it's been working for you.
Yeah, but it is working for me, but I'm getting, like you said, it's a pain to go through the process every 2-3 years, and I'm getting kind of irritated in doing it, and the savings and the time is getting to a point where it's not worth it for me anymore, because my time is getting tighter, and the interest rates, the difference is like 2%, and I'm not going to be worried for 2% for a bunch of time that I have to put in. So yeah. Thank you.
Yeah, no problem. And what Mark is talking about is something that it's a non-monetary thing, but it's called a PETA factor, right? So Mark is saying the PETA factor is too high. PETA factor stands for pain in the ass factor, right? So if I'm Mark and the PETA factor is high enough where it's like, hey, it's not worth my time, and I don't like, it's great that I'm saving interest, but I don't like, the idea of having to do this, then I wouldn't do fixed. I would probably still do variable. Right? You could go either way. Personally, I don't think they're going to be able to raise rates. I think that if they do, things are going to get worse. So I would do variable and just lock in something like that. And it reduces my PETA factor, even though my interest cost will probably go up. There's probably some time, money, and PETA factor savings that you have with that. Okay, looks like another question here from Nano. Let me bring Nano back on.
Hey, Jerry.
Hey, Nano. What's your question?
Yeah, it wasn't necessarily a question, more like a comment, right? Just realizing that the financial trap that basically we're forced into, whether we want to it or not, right? And I'm talking about just not a mortgage itself, but what the Federal Reserve System is doing. So if I understand that, and now like I'm in jail, then I need to make a sprint to break free, which means got to get to passive income greater than saving, expenses, and taxes. So for me, I mean, my story firsthand, I align everything to make that happen, right? Sold my car, moved a few times, and I did what I had to do for the opportunity. So it's just a comment to make it a sprint, realize what's actually going on, which when I realized, I was a little depressed, but
I saw.
But make it
I was
a sprint.
there.
But it's just a comment and not much of a question.
Okay, awesome. That's a good comment. And Nano is right. Like when you realize the reality of what's actually going on, and that it's not, this made up scenario, and it really is financial slavery, you don't stay there, you get out. Okay, we have a question here from Adriel Martin. Adriel says, how would you refinance your HELOC after you reduce your taxable income? Wouldn't they need to see your tax returns again? That's a good point. So once you're in with banks, like once you've done a loan with them, sometimes they're going to work with you on the basis of you're a return or repeat customer. So that's something that you'll have to look at on a case-by-case basis. Again, this is why we have a team for this, so that you're not going to the bank and be like, yeah, I did my HELOC. Yeah, I hired a CPA. I lowered all my taxes. And then you go back and they're like, dude, your income is terrible. Right. So when we know that that's going to be the case going into it, there's some strategy we lay down ahead of time to make sure that, okay, we've got the right bank, we've got the right tax strategy. If it's going to be a scenario where the bank's like, you have to show X amount of taxable income, then when we do your tax planning, we just always keep it right above that number. So that way you never go below that. Some banks will take what they call GAAP accounting, generally acceptable accounting principles. And so you could show them, hey, my tax return went down, but based on my GAAP, you can see that there is income there. And so some banks are willing to go to bat for you on that basis, but it all depends on, again, who's representing you, who your bank is, who you're working with. All right, guys, I think that those are all of the questions we have. Great questions, Sam. Let me just make sure there's no more on Zoom before we wrap up here. And again, guys, if you're watching this for the first time, we will be back again next Friday, same time. If you have not gotten a copy of my book, Blueprints of Financial Freedom, and read through this, go to jerryfetta.com/B2F. Again, jerryfetta.com/B2F, and you can grab a copy of that. You can read through, get the HELOC strategy. Again, it's the whole blueprint. So we talked about one thing tonight. That's literally one tiny little piece out of dozens. Okay. So guys, I think that that's all we have. We're going to wrap up. Everyone have a great weekend. Thank you for joining in, and we'll see you next week.